throughout a month, the better will be your learning. So today's session is basically looking at your startup more from an investor and a VC point of view. What exactly are they looking for? And when they say what is 10x returns, okay, when is the IPO? When is my exit? Okay, so that those are some of the things which we will try to address today, and it'll help you in the long run in your understanding of what is happening within your organization and how to make it more VC friendly or how to make it more investment friendly. I think Hemant has been associated with the IT startups for the last 6 months. He's been mentoring startups in our previous cohort and also in this cohort. He's based out of Baroda, Baroda and or Baroda. So Vadodara. I always knew it as Baroda. Okay, and he runs Gujarat Angels, and very strong supporter of all of you. Thank you so much. Over to you, Hemant. Let's take it
Thank you.
forward.
Thank you, Anjanda, for your kind words, and look forward for a long-term association on a personal capacity with and professional capacity, both with IT startup and along with you. And look forward to be part of the journey of this entire gamut. Good to see Raj kissing his son. So I believe this is a fairly interactive session around. So good. But anyway, so this session, which probably I'll talk about, is primarily so what happens is when an investor approaches you, could it be a family office or could it be a VC? Primarily, we all are at a stage. Most of us are on a stage where probably we are either at early or could be a bit of, which I could say it across slightly late, but still early, because I don't think so we have been reached the number which probably we had an expectation to reach in that point of time. So probably, so I was talking to Anjada in the morning and I was saying that what all should be a learning from today's session could be. So if you look at it today, it is not the numbers which investors look at it when they want to invest in us. They will look at the value proposition. Now, value proposition in terms of solution, probably whatever you have been talking about it, you would have fairly known the problem statement. I always get excited by looking at that TAM, SOM and all stuff. But primarily what happens here is that the reach, the value proposition, you built it up in terms of your product. So how it should be built it up ideally in our case, where our numbers are probably what numbers to target. So when I was doing one of my current in cohort, when I was talking to the founder, so he just gave a number of that he wants to raise 1 mil. Now 1 mil is fine, good to raise, but then how we are going to spend this one mil? Do we have any numbers going forward, how things would be? Because we all have that in terms of that what we are doing it today, but what we are trying to achieve. So in case if we talk, say, any number which we talk about it, it has to have a rational to be to back to it. So that's where probably we need to understand the economics of probably, which I'll say it across, say, unit economics. So unit economics, what it is all unit economics is all about. So unit economics is where probably where in case as a unit, how do your costs stand to? So for example, if you're building a health tech where you are trying to build an aggregation platform for doctors, now there is a certain cost to it. There is a certain additional cost to build that entire platform, and then probably you have revenues to it. So if you have to look at it per se, that I want to go to 10 cities, but how about that one city where you already have a presence to? how you have fared there. And if you have not fared today, what are your plans in next 3 to 6 months where you want to look at it? So there probably the unit economics which comes in play is where they would like to see it across that how this entire spectrum of the entire cost comes closer to the number which we want to achieve. Uh, so how that could happen? Now that could happen only, as I've said just now, that all the cost has to be put across to it. Now, once we have been able to put the cost to it, same way we can put a revenue models to it. So I will showcase to you actually what I meant it across, but before showcasing it across, what happens that we straight away jump to the presentation. I just want to build this up from here where what I want to showcase. So let's look at it unit economics perspective. What is most important? Do we know that what all cost would be there in terms of aligning for that particular unit? Have you taken it account for or not? So most of the time what happens is that we as a founders miss on the number that if, say for example, if my particular project would have or venture has a 20% towards a working capital my requirement. So have we counted that 20% in our month-to-month sheet or not? Unit economics is also about, I've just said it across as month-to-month. It is not about quarterly or annually. Because what happens here is that you have to have your unit economics in place because of the simple reason is that that helps you in terms of getting your all cost in it with more clarity on one side. And then probably if you're looking forward to build your revenues line 1, 2, 3, then that helps you to understand that 1, 2, 3 as well, revenue 2 while going forward. So I believe I'm in last 5 minutes, I just spoke about unit economics, and my urge to every whom's the audience here is that probably try to understand beforehand in your venture, where do we stand in terms of unit economics? Today, in now my second topic, which will be probably I'll talk about it over a period of time, would be is free cash flow model, which probably now in winter funding, everybody is talking about it. Now, winter funding or no winter funding, I'll not talk about that, but I will talk about certainly that how we should build a more ownership model too. Now, what is happening in PEVC industry, everybody knows about it, but still I like to talk about it, that gradually it's a more, the ecosystem which is building up is a more ownership model which is building it up. Earlier it was, yes, probably you fundraise and then probably you run accordingly. But now things have been slightly different, where probably investor wants to know that how you're going to invest his money and probably what would be the exit you're looking forward to it. So most of the slides which I have seen it across of in the page probably talk about profitability. I hope profitability becomes zero after every 31st March. So there is nothing like profitability, which probably you carry in your books. It's the cash flow which you carry in the books and which builds your ecosystem. So my request to all of you is that whenever you are building your venture, think about cash flow rather than profitability, because ultimately cash is a king. We all have, though everybody talks about burn rate, but what is actually burn rate, where it is leading to? Burn rate is leading towards the cash flow. So how we are building our cash flows is the most important thing. Now, once you have been able to build your cash flows, then probably you would be knowing exactly how your venture would play, even in terms of 2 to 3 year perspective. Why 2 to 3 year perspective? Because ultimately, maybe you have not to return the money into 2 to 3 years time if it's a VC, but the idea here is that this brings lots of ownership to us in terms of understanding that how the particular, once we have got the fundraise done, how we are going to use that fund to build it up. Now, I believe we all have we have to all appreciate the point that every second company or the third company we are looking at it is not going to be doing an IPO. So what should be our journey? So yesterday I was talking to a venture who is currently into a M&A, and they are doing, so they are on the other side of the table where they are looking forward for good mergers across the globe. Now, probably this all comes in the play once we look at it from that perspective too, that I know business are fairly I believe we all know that how business plays when the ecosystem is current times are, or maybe not as a current times, it's always good, bad, depending on how you put your venture to. But the idea here is that how we make that cash flows to run it across, to make it a slightly more disciplined way of putting it to the set of investors whom you have already onboarded, or the one whom you are looking forward to onboard, or probably from a merger and acquisition perspective, you have that say to look at it. We will all understand this point, that how financial prudence would help you in terms of the valuations probably which you look forward for your venture to look at it. Now, I will actually put it this way, that whenever we look at it, any kind of valuations, probably, I don't know, one of our colleague has done, in fact, one of the session on these things as well. But happy to answer these questions also over a period of time in today's session, in case anybody has it across. But the idea here is that these all things, valuations always get answered once you have financial prudence. Valuation always gets answered once you can show how you are building the business too. Probably what happens is most of the time is that we always miss the bigger picture of that, how the entire your business would look like it from a 15-18 month perspective, not beyond that, because we all know that how things are in business. And once we are growing our business to where we have a lower base to look at it, probably on one side we can say that we have done 100% growth, but on a 10 lakhs, if you do 100% growth, you know what that means too. So but point here is that once you can show the financial prudence, once you can show it across that how you have been improving your EBITDA margins over a period of time, I believe that matters a lot. Because as I said it across, cash is a king, which probably you carry in your books year-on-year basis. And that builds your profitability, that builds your businesses. And that gives you prudence in terms of what could be the next game plan in terms of from a product journey perspective. So, so I was talking to the current cohort, the portfolio company which I'm looking at it, I was talking to them on that perspective. What next? Once you are building your cash flows, what are you looking at it in terms of bringing the, because ultimately you need to stay ahead from your competition as well. The moment when I see any of the portfolio companies have been building up, you'll certainly find there is a competition catching up there. So how you can stay ahead to the competition? It's only through once you keep building your products. So I'm slightly varying from the topic, but the idea here is that, and but still coming back to the discussion, once you want to build up a product, you need to have that kind of cash flows to back you. Every time you can't go to the market every 6-8 months to raise money. Probably that doesn't show financial prudence at your end, and probably you also find difficult to raise money over a period of time, because every 6-8 months you can't do it across. You have to have that kind of charity, or probably you could have that kind of your commitment. And that how that commitment can happen, probably we can discuss that, but that is a milestone-based commitment. We can talk about it. And so milestone-based commitment is just giving you the comfort that the investor which has come in the current round will come in the next round as well. So I believe this is all probably we are going to discuss into this session, and look forward to be interactive. Up till now, whatever I just spoke about it, any questions, happy to answer that. Otherwise, probably I'll go to the free cash flow model, which I'll discuss it all. Yeah. Any questions up till now? Maybe you can type, or maybe you can speak. Anybody can unmute and can talk about it. Any questions on unit economics or whatever I just spoke about?
Yes, Manish. So I have a question. So many of the startups here, they are like pre-revenue or very early revenue, and this cash flow model, I'm somewhat familiar, but I would appreciate if you can shed some light and make some comments about what these kind of startups should do, like whichever model you are discussing.
Thank you, Manish. So Manish, what happens here is that even at that early stage, how everybody has to have that kind of comfort with the founders himself or herself, that how the ultimately my model would flow with. So basically, once you are putting resources to, there is always should be a check that whether I should hire a guy which I had to pay say 40,000 odd, or should I hold this 40,000 for my GTM strategy. So I believe any point of time, even when you unit economics has nothing to do with revenue. Unit economics has more to do with the cost. Manish.
Okay.
So what happens here is so basically what happens here is that primarily Avikal, I will answer your question once I have done free cash flow. But just to answer you, Manish, on this part, probably if I have to look at it holistically, today, whenever I'm doing a resource planning, so unit economics is all about resource planning, where probably once I'm putting all costs to it, I should be fairly making the choice with all possibilities that 40,000 I should spend on an IT hire or 40,000 I spend on my GTM strategy. So basically, it is all about resource planning, how we do it across. Revenue comes in the play once we look at it a cash flow perspective. Hope that answers your question, Manish.
Yeah.
So basically,
Understood.
it is.
Thank you.
Yeah. So basically, it is more to do where probably we have to put a cost matrix to it and figure it out what would be a fairly value for proposition for me. Yeah. So Avikal, what question you have asked, I will answer it this way: that free cash flow is something. So profitability is. I'll show you my model. It will get more clear, but I'll just tell you that cash flow is where probably you have sold your product and you're going to get money out of from your customer. Now that money which you are coming in your bank is not your 100% profitability. The profitability would be say 20%, 30% on that cost. So that particular entire 100 rupees which comes to your bank account is your cash flow. Out of that 20-30%, only which is your EBITDA or net of your margin, probably that will get into the profitability. So I'll discuss that. Yeah. Any questions there? So no questions here. Then
raised hands, Hemant. So I think you can continue. If anyone has any queries, please raise your hands. You can also send it to me via chat, and in between I'll ask them. But please feel free to raise your hands.
Yeah.
Thank you. You can continue, please.
Sure. So thank you very much, all of us. Now I'll just go to share a screen where probably I'll try to show the cash flow side of it, which will help you guys understand what exactly free cash flow means and how does that help the business side of it. So probably this is one of the portfolio company in the agri-tech space where I did this model. I keep doing it across this model, but this is one of the model which I did it sometime just 3-4 months back, and I keep coming to this. So if you look at it, primarily, they have been having 3 revenue structures to it. So one was into green vegetable, third was grain and pulses, and second was that over the counter they sell few products too. So primarily, if you look at it, how on daily basis this would play a role. So if you talk about from an early stage perspective, where we are not doing revenue, probably we can just look at the cost part to it. But certainly, as in once we are building this venture, we should be fairly clear in terms of why we should follow this metrics in our portfolio, because this helps on the transparency basis. It helps in terms of particular. If I have to talk about from perspective of that, maybe you are doing 3-4 revenue lines. What is an EBITDA to every revenue line? So this helps you driving up to that level, and then probably it helps you taking right decisions once you are building this entire venture over a period of time. So here, if you look at it, they have been doing some odd 20 odd tons on a daily basis. And if you look at it, this is how their revenues are building it up on a daily basis. So probably in terms of percentage and all, we will not discuss that because that will not be meaningful for every venture here. But certainly, this is a formula driven. I will send it to Sony. So anybody who wants it can take it from Sony. But the idea here is that this helps you to gauge that what would be my revenue to it. So in case if you look at it, this piece, so just to an idea that my revenue would be, if I have to look at it from a perspective of, if I have to build this up, the revenue would be of this number. So this is how they have taken it across, that ultimately this will play a role of building this up. So I believe revenue is something which is, they have talked about it here. Now they have talked about the COGS part. Now COGS is that operating cost, how this would be playing a role once they are building it up. So they have said that in case if they have to build on a day-to-day basis, this is how their cost will get inculcated. So here, this COGS is something which will, so if I have to just give an insight that this is all has built up with the formula driven, but the idea here is that if you look at it from a broader perspective, this all has been built it up, keeping that in mind that how the overhead cost will play a role in once they are building that particular revenue line. And then if you look at it going bottom of it, probably you will see manpower cost and all which is coming to. Then probably we'll see to it that how keeping that total sales and keeping monthly expenses in mind, what would be my gross profit. Now, probably this particular is a very important thing where I've done this net profit to it. Now, this net profit helps me, or a gross profit helps me to understand that this is how my post EBITDA would play a role. And this also helps me to understand that what would be the overall. So here in this case, they have some 10 days lag of getting the money from their B2B customers. So keeping that in mind, we have identified that they just get money. So if they're done a sale of 2 crore 34 lakhs, they're just getting they're just getting 50% in that particular month. So their cash flow is basically, I hope probably for everybody who has to understand this piece, that they're doing 100 rupees sale, but the actual cash flow they are getting it across is just 50% of it, because that's what their business is all about. So here, that's what probably they have asked for their 5 crore requirement. That if I get a 5 crore working capital, if this is what could be infused to their funding, that's how this will, their net cash flow deficit. So here it is a cash flow positive. They're showing it across because this is a fund has been infused. So my what is the most important thing to learn here in this particular E26 is that if I have to make an ask, how we should make an ask. So this ask is fairly, it's all formula driven, but ask is being basically on the basis of that what cash flow I'm going to get it from my revenue numbers. Now, somebody who is building it from day one, from scratch, how they should reach out to their angel investors or early stage investors where the revenue is not happening. Probably we can just look at it. Maybe we can just omit the revenue part and we can just look at it, the COGS and expenses to it. And then probably we can see that, so there will be no gross profit, no net profit. It will be exactly, will show that how much cash flow we are negative from day one. And actually, rather going in a way where probably without any direction, you go and ask and say that I need a 1 mil. Probably this is a more scientific way of going to them and asking them 1 mil or 2 mil. So ultimately what is happening here is once we have done this kind of exercise, then this helps you to understand that your deficit, or actually this is a cash flow they will have it across. So month on month, this is how your cash flow would look like. So primarily, if you look at it, now cumulative cash flow required here is, this is a cumulative cash flow required, which is the E27 plus H27, which would be required over a period of time. So probably just to answer you, most of people will get their queries answered here is that we have to understand from month on month basis that what would be my probably cash flow would be from day one or month one. And this helps you. So when we go and put our asks to, we have a fairly clear-cut idea that what would be my ask would be, and how I'm going to utilize that ask. So most of the time, it happens is that we just put a number, say that 30% will go there, 40% will go there. Instead of that, let's do some somewhere we have to do that kind of micromanagement, where we have to figure out what had the cost would be, and how that cost would help you in terms of getting that what you're you want to achieve over a period of time in terms of value proposition. Now, if you look at it here from a month 1, month 2, month 3 perspective, but just look at it. The micromanagement here, we do it across from a month perspective. And also to look at here is that they are saying that every quarter they will look at it to grow their top line. So look at it here, they have considered that as well. This is all formula driven. So what my request to you is that whenever you are putting it to set of investors or internally as well, I hope every time we have not to go to investors to look at it, but once we have to look at it, vetting what we want to achieve, to answer one of the questions asked earlier, probably let's have that conviction that we would be a revenue making machine rather than just a cash burning machine. We all are getting into us from an entrepreneurship perspective that we want to build revenues to it. So and probably this all which I put it here is 600 or 750 here. It's all unit economics. We are not putting it. We are not putting it at anything in terms of where we want to give a number which is probably you feel or the investor or any entity feels that this is not achievable. So at any point of time, if you are reaching out to a strategic investor, these are the small things would be asked. And that would be go for the validation. That if you are talking about any number, so look at it. If he is talking about 750, so I believe he is just talking about some around maybe some 20%, 30%, whatever the growth they are talking about here. I believe so. This gives a validation in terms of that. If I say that I want to grow by 20% in every quarter, so this is how you look at it. Unit economics plays a role in terms of your revenue. And I believe it's not revenue only, it's also on the cost part. And so somebody who doesn't have a revenue, I hope this is what they would be looking at to build it up. So now what happens here is that on one side, we have a aim of one side, we have a aim that in terms of we want to build this up. But what happens here is that we need to quantify that whatever that we are aiming to. And this is something which helps you in terms of quantifying it across. Probably also, this helps you in terms of resource planning, that maybe in next quarter, if I have to achieve 20%, what all should I look at it? Should I look at it organic way, inorganic way? So that's where probably you will get into that kind of deliberation that what will help you to achieve that number. So from that angle, this entire gamut helps you to get close to that what you're looking forward to achieve in your business plan. So this is probably if you look at it over a period of time, they have been looking at it that maybe in maybe next 4 months, they're looking forward to grow this from a 600 to 900 kinds. So this is how this helps you over a period of time to grow and put it to a number which looks to be achievable, because as I said, unit economics helps you to get that number perspective to it, that what is I should look at it from the cost perspective, how that additional cost has to be put in across. So I'll again pause it for a while here before I go to the detailing of the free cash flow perspective. But any questions up till now, we are happy to answer them. Yeah, over to you, friends.
There's a question from Shiv.
Yeah, sure, please.
He says, in the free cash flow, do we need to consider compliance costs like taxes, GST, etc.?
Okay, good question. So if you ask me across, very much do consider the across, because ultimately that goes from your pocket. GST comes as an input. So probably we all know that how that input will get refunded to. So I believe we all have that idea. So certainly, and tax is something which goes out of. So any cost, any flow which cash flow which you feel which is going out of the book should be part of our free cash flow perspective, because ultimately that is going out of and for us which are early stage, every penny which goes out matters for us, because then ultimately that is affecting our cost side of it. Hope this answers your question, Shiv.
We
Thank
have,
you.
we have Prakhar raising his hands. Prakhar, please go
Sure.
ahead.
Yeah. So so basically my question is, say when we do projection, right? Say if we already have the cash flows, we know like how much percentage of is increasing in technology and marketing. But when we need to do projection, so how do we set standard that will we grow 5%, 10%, 15%, 20%? So is there some logic behind that? Or it's like
Very much,
our
yes.
past history? Yeah.
Very much, yes. So what you have, I hope you have answered yourself the question. So probably what happens here is that financial models are built on past history most of the time. So if you look at it today, you're doing X revenue with say 20% cost. So actually we were doing one costing for one home stay for one of the portfolio company, and then they said that so there is a working capital requirement for on day-to-day basis, and we realized that that is around 20% to it. So I believe we can fairly put a number to it, a percentage to it, and just drive that across. Probably with a variation of 5-10%, we have seen it. Our observation is it has not gone up much, unless until you have a bigger plans too. Like, so for example, tomorrow you decide that I have to put a US entity, and then probably once you have to put a US entity, it has a cost to it. So the idea here is that this particular planning also helps you that how you should plan your capex to opex as well. And I know there are in today's startup world, nobody finances your capex, but the idea here is that that gives you a fair idea in terms of that how this capex opex has to be built it up in my financial model. Hope this answers you.
Yeah. So actually there is one follow-up question here. Say since we are like very early stage, like only 2-3 months in revenue, and there it's not stable, right? So it's not like a stable curve. You can have like higher, you can have lower in some month. Then like it's very hard, and whatever we have projected, it doesn't come out to be correct as well.
No worries. So basically then what happens here is that, have you built your own internal model, Prakhar?
So model, I'm not very sure. We just take like
no. So
standard.
hang on. So once you have not built on model, this would happen. Build your model first.
Okay.
And then build a variation curve for yourself. You will come to know yourself.
Understood.
Still, you need any answers? Probably you can come back to me.
Sure.
But first and foremost thing, you have to build your own financial model.
Got it. Yeah.
Something of this sort. And then you can map it across to it. Actually, then here, what you can do is put a, maybe you can do one more Excel here, where projections to actuals.
Got it.
And this will fairly give you an idea by the end of say 4th month that how your projections are going.
Understood. Yeah.
I can wait for it. You can come back to me. I'm here. Maybe
Sure.
you can come back to me.
Yeah.
Thank you. Praneeth has his hands raised. Praneeth, please go ahead.
Yeah, hi. So my question is about how this cash flow and the financial model would link to the amount of fundraise that we would do. For example, let's say my first year, I'm say negative 50 lakhs EBITDA, and then start making positive EBITDA from year 2 onwards. And then let's say the annual expenses, just the expenses are 2 crores, just pull some numbers out of air. So do we need to fund only that negative 50 lakhs cash flow, or do we like look at just the expenses, ignore the revenue, look at the expenses? And
no, so revenue, I hope we can't ignore revenues in it on one side. Probably the cash flow comes out of it, but then I don't know what kind of business you are into, if you're a B2B or a B2B to B2C or a B2C business. So probably, say for example, if you're a B2B business. Now India typically, this B2B business has a cycle of 30 to 90 days kinds. So ideally you should build your cash flows accordingly, that today, whatever the business you are doing it, probably you will get eventually that in say 60 days of time. So then build your matching cash flows accordingly. So what will happen here is that actually you need to fund your business for next 3 months if you are blocking your 50 lakhs towards this B2B client. So this 50 lakhs you require as a funding today.
okay.
And eventually this will be part of this. If you look at it from the cash flow perspective, this is exactly a B2B model. Now, in a B2B model, if you look at it here, they have actually tried to see that across that how my cash flow would be. So for example, whatever they have sold this month, they will just get this month they will just get a less cash flow from customer is only this much out of 234 is they will
Okay.
just get 1 crore 17 lakhs here. So precisely to answer your question, you need to carry your revenue with it. One. Secondly, you need to carry revenue can't get directly linked to your cash flows. So revenue has to be put in across maybe in 3 months time or at 6 months time. That is businesses. So probably I can't do much on there, but that will help you to know that exactly today 550 lakhs which you have spent on the business, when that money would come back, you'll know about it. But then you have to get this 50 lakhs for acquiring other businesses as well. Hope this answers your question, friends, or still you need more clarity?
Yep, it answers the question.
Fantastic, lovely. So I hope you need to carry it across. And my request to all of you here, audiences, please create your model here. This and this will help you in terms of understanding that across that how this entire model would be over a period of next, say, 3 months time. And this will fairly fix the problem statement which we just spoke about it. Yeah. There more raised hand. Yeah.
Yeah, Himanshu had raised his hands first. Himanshu, please go ahead.
Yeah, thank you.
Yes.
Hemant, a quick question. So at what stage in our discussion would a VC want to look at this financial projection sheet?
So honestly speaking, okay. So there is any point of time, VC may not ask this, but for your clarity, you should have it. Say for example, today you say that I valued myself, say 100 crore. I'm just putting my, so why 100 crore? So you could say that I'm doing a 10 lakhs a month revenue, and this will yield me a 1 crore 20 lakhs, and on 1 crore 20 lakhs, I'm taking a 10 times. So 10 times even makes it 10 crore. So basically that's how I'm valuing my 10 crore myself. Now it goes to the level of where I've just said that how your cash flow would be against a cost. So this is how this will help you to understand that my EBITDA margin currently is far, far better than any of my competitor. With this kind of a sheet, probably you will have that help you to understand, and probably you can do a better negotiation there. So VC might not ask you this. They will just go by your revenue into 10x. Well, I'm just giving this example. There could not be a case because every VC looker has a different metrics to look at it. But certainly this will help you in terms of understanding, Himanshu, that where my venture is heading to, how much, in fact, gradually, if you look at it, maybe, so I was talking to a company which is doing fairly good 780 crore kind of a top line. They have a low EBIT business. But then they said that if they have to bring international investors or even investors from India, they said that they have to improve their EBIT, though there are listed entities with the same EBIT. So what I'm saying here is that probably that rationale helps you to negotiate it better. I don't know in your space there are competitors or not, but that helps you in terms of putting that number to it. So we all talk about it, we show it across in terms of our that tangent XY, that this is how we are best, but ultimately that would help in terms of your EBIT margins as well. And this EBIT margins comes from here, where probably you know very well this is how I'm going to build it up.
Thanks, Hemant.
This is how my
yeah.
And one thing more here, Himanshu, what is happening here is that probably this will also help you that, say for example, after 3 years time, what could be the cash flow I will have it in my hand to pay it back to investor. So I can tell him across very with more clarity that I will give you 5x on your investment money. So this all helps you in your confidence level of how you put it across, Himanshu.
Right, Hemant, I got that. So a follow-on question, since you mentioned my space, I'm into EdTech. Now, when we are talking about cash flows and EBIT, the top company in the EdTech space is currently at minus 4,500 crore as of FY21 declaration. Then how does all this discussion fit into that?
Dude, so I just met this guy also from EdTech who is doing an acquisition in one in Thailand and one in Manila, here in India. So probably what you see it floating is not always probably is right. So in a way, probably I will put it this way, that we have to find our mojo and let's keep building it up. Probably if you talk about EdTech per se, I'm a startup enthusiast for last 6 years. So I will say it this way, that probably some point of time, course correction has to happen, and probably we know that is happening. Now, hoopla around that there is a massive layoff, things like that. I hope we all know that why it is happening. And so now, if you look at it, the larger one which you're talking about it, now they're getting into offline mode. So the online people, they have hide for their just putting it aside. So basically what we are saying it across here is that finding an mojo, which is most important thing if you look at it from a EBITDA perspective. So I'll give you an example of Paytm. We all know Paytm that their expenses are of miscellaneous expenses are 1,000 crore every quarter. And that kind of losses they do. So what kind of expenses they do in miscellaneous? Now, if you look at it, if you have done it, if you're doing it from day one, you will know that would be your miscellaneous expenses, what would be your miscellaneous cost would be. So this will help you to control that. This is a control sheet for yourself. You have not to do anything with the VC. Hope this answers your question, friends.
Yes, thank you so much.
Thank you. We have Shiv who has raised his hand. Shiv, please go ahead.
Yeah, sure.
Yeah, hi, Hemant. Quick question. In this realized cash flow from customers, right, do we consider advances that have been received from customers for services not provided? So, I mean, it is a liability, right? I mean, for me, if I have that advance with me, but is it fair to consider that in my realized cash flow?
Very much, yes, because that is in your bank account and that you're utilizing it to building
So
your,
that's what.
Yeah, very much, yes. Because ultimately, so what is cash flow? Basically, cash flow is anything which is coming to you from all the sources. I hope this is a revenue source which I've come across to. So probably you can put it here as a cash flow. This could be you can create a bifurcation here, an advanced cash flow and a actual cash flow, or the realized cash flow. So you can have an advanced cash flow and realized cash flow, and you can build it. So this is something I'm just showing it across for all of us. Then probably we can just look at it and create it as per our business model.
Yeah, I was just not sure if we should consider, like, for in our business,
very much, yes.
you know, it's a B2C, and so we have a wallet payment, so people can fill up their wallets, right? But they don't utilize the money in the wallet, but of course it's in our bank. Right now, is it right to consider that as part of our cash flows?
Very much, yes.
Okay.
And I'll tell you why so, because ultimately this will help you in terms of your unit economics. So for example, today you have got your wallet because of the reason is that you have got, say, 40 people have given you advance.
Correct.
So actually you're servicing 50, you have got 40 more. So actually here it will be 90. And this 90 would help you that what would be your planning for the next quarter. So that means that 40 which have paid you in advance, maybe this would become 80 over a period of time in 3 months. So by default, you can put it 80 here. So this will help you in terms of you're planning your cash flows better. Maybe not today, maybe down the line 3 months.
Sure. Okay. Thank you.
So this helps you even to look at it, that what percentage growth we are looking at it. And against that percentage growth, probably this will help you also going forward that what would be your cost to it.
Got it.
Hope this answers.
Yes. Yes. Thank you.
Praneeth, please go ahead with your query.
Yeah, actually, a follow-up question from what I asked before. So I was wondering, how does this help me figure out how much funds to raise? Is it like a cumulative cash flow deficit that needs to be funded when we do an investment raise? Something like that?
So basically, yeah. So once you put a cash flow to it, you'll get a net cash flow here. Now the net cash flow is, so here, if you look at it, he has a deficit of 1 crore 17 lakhs, right? Against that, he has asked from an investor 5 crore. If 5 crores gets, then he will have a net cash flow. He will have it is 2 crore 63 lakhs.
Okay.
So this is how this will help you. And then and again next month, because probably he's not getting. So if you look at it, second month he is not getting any cash as a working capital.
Okay.
Because he has not got funding there. He has got funding in the month 1.
Right.
So this will help you in terms of the funding which you have got it across, or you're going to supposed to get it across. So most of the time it happens that what is your actual plan is. So actual plan is that I have not got the funding today, but maybe if I start discussion today, maybe after 3 months, I'll get a funding. So here you can put your working cash flow, working capital here.
Got it. Okay.
In the K26.
Yeah.
So once you put it in K26, that will give you an idea that how that things would be from there on.
All right. Thank you.
Hope this gives clarity.
Yes.
Prakhar has a question. He asks, when we
Please.
say top line revenue, what does it mean?
Okay, great. So basically top line revenue is in case you have a cost of for it. So we have done this basic maths long time back, but still happy to answer this. So 40 rupees is a cost to a particular product. Now, 20 rupees is your margin. 20 rupees is the transportation cost. And 20 rupees is your miscellaneous cost. So it makes it, I believe, 100 rupees. So 100 rupees is your revenue, which probably you are going to bill it to your customer. So actual realization would be 100 rupees to you. So you put that 100 rupees here in terms of when you look at it a revenue perspective. Of course, keep the unit economics in mind. If you're doing it for say 10, 15, 20, just keep that in mind. So 10 into 100 or 6 into 100 or 4 into 100. So that is a revenue to it. And then accordingly, you put a cost to it, which probably I've just given some of the examples. You can keep adding here, the cost to it, cost heads here. Hope this answers the question.
Yeah, correct.
Awesome. Yeah.
I think you can move on, Hemant.
Okay, sure. Thank you. So primarily, if you ask me across that how we look at here is now let's look at it there. What we have tried to do here. Now, when we look at it a fundraise perspective, I don't know, in earlier sessions, my college colleagues have taken this part of or not. Probably we need to always plan for a 15 to 18 months from a fundraise perspective. So how our cash flow would look like. So because every second month, third month, we can't go and raise funds. And that doesn't make sense. That I've seen ventures do a 5-year, 10-year plan. No, that will also not help with the kind of volatility we have, the kind of base we have, the kind of businesses we are building it up. So we have to just look at it, staying focused, that how things would flow or pan out once we look at it from a next 12 to 15 or 15 to 18 months perspective. Because anytime when we want to do a fundraise, at least takes 3 to 6 months, even from a family offices nowadays. Because early investments have slightly dried up. I'm very happy to hear from today's audience that they have got investment at our early stage as well. And now everybody looks at it, that how things are, how the product would look like, and then it will they find a value to it. So if you look at it here, this particular founder has put in at least perspective of that how from an 18 months perspective, what fundraise I should look at it. And this fundraise, whatever he is talking about today, he has imbibed in his particular cash flow when we need to look at it, that this business, this kind of investment, when I'll get it across, how I will put it in my cash flow. So what I have to just tell you across is that if I have to plan my fundraise today, tomorrow, then I should be clear that what numbers we are looking forward to it from at least from a 15 to 18 month perspective. Because as I've just said it across, even from a valuation perspective, even from a slightly more institutionalized perspective, it always helps you have that kind of plan to it. Whatever the round you want to do it across, convertible or a pure equity, that is something probably I'm leaving it to you, but this helps to get you better, in fact, managing your finances better, to look at it from a broader perspective. Yeah. Any questions on this? 12 to 18 months? Any questions on what kind of fundraise I should do it across at this juncture? Any questions on probably how I should look at it, the valuation front? Maybe I can answer that as well. Though this is not what discussed, but I can answer that because this is all linked to this. And we should have to have a very logical way of putting it across to investors, or even for internal, even if you have to do ESOP, things like that. Probably we should have that kind of backend, and the backend envelope. This kind of calculation helps. Yeah.
Avikalp has raised his hand. Avikalp, please go ahead.
This might be an outcome of being a very early stage founder, but this time when I was raising fund, instead of doing like a proper P&L calculation, I only did it estimation or projection for expenses and costs, and based on that, I was like, I'll just try to cover all of that using investments. Is that a valid strategy? Like just talk about the expenses there, because you can't really know how much money you will make.
No, so honestly speaking, probably I'll just go back to my first discussion on unit economics. Now, what happens, I'll give you an example way back. In my initial days of a startup. So I was actually now I'm more than some 30 odd years of experience, but last 6 years I'm into the startup side of it. So we all are very founders are very interested in terms of talking about numbers. So they jump up and say that we'll do 1 mil this year. So what is 1 mil? One is 10 lakhs. Now 10 lakhs divided by 12, which makes it close to do a lakh of revenue a month. Now, or maybe 80,000 odd. Now 80,000 divided by 4, so 20,000. So probably my request to all of you is that do unit economics of your venture first. Now, why so that we don't know what we're trying to achieve, but we should know that when are we going to get my first paid customer? Either first month, second month, third month, fourth month, fifth month. If it is not happening, then when? So one. Secondly, when am I going to have my second sale? So let's that stack build up accordingly, that how this would play a role in terms of that how this revenue of 1 mil, if I'm talking about it, to have a planning of a 20,000 monthly sales. I'm not talking about from a B2C perspective, from a B2B and B2B to B2C, we can discuss one-on-one. But coming to the discussion here, probably even at early stage, when are we looking to quantify our revenue stream? We should be very clear about it. We should be very much clear about it. This helps internally for even if you are hiring, even at intern level, you can give the visibility to him or her that how things will play a role probably once you look at it from a venture perspective. So, so just to answer you here, probably put unit economics to it before getting into the free cash flow. Free cash flow comes later on. First thing comes unit economics. Have unit economics in place. Just think about it that what would be my unit economics, how long I will be putting cost to it. If I had to do burn, how long we will be doing a burn? If I'm not been able to, so we all will look forward to do funding, outside funding, but we all know that out of 10 startups, only 1 get funded. These kind of things helps you internally to figure it out that if I don't get funded, what will be eventual? We should all know about the fact, which is a eventual reality of getting businesses out of. So I'm not giving a gyan here or demoralizing anybody. No, I'm just saying it across. This helps you to understand how things would be look like. So anybody who comes from army background, the major before leaving the house, they have put a mirror at the main gate just to look at themselves. So this is just a mirror to ourselves. And so it helps to understand us that how things would be eventually once I'm getting into this. I know probably you would have been looking at it. You would have already looked at it, TAM, SAM, everything. But the idea here is that even we have to look at it to get a revenue side of it. So we have to look at it that how long the cost would be putting into it. And this helps you to even this helps you to in terms of looking at it that how you should plan your resources. So in fact, so I actually I'm into fundraise as well, but primarily what I have looked at it here now is that I don't look at it fundraise purely. I look at it resource planning as a whole. How good we are in terms of our unit economics, how good we are in terms of free cash flow, how good we are in terms of managing the entire business side of it. How do we see the visibility of our revenues?
Hemant, I have a follow-up question. I have a follow-up question on this. So when we are, going through the PMF iterations, so the projections, how do we do the projections for the revenues? Like,
so basically, so let's take an example. You are into a B2C product. Now, B2C product, probably you are driving, you have seen it across that your social media is a hit. So the current portfolio company, which is in my cohort, I try to convince them that we should have a feet on the street sales guys as well. But then founder said that, boss, we are not comfortable at this stage to have a feet on the street mode. So I'll put it this way, that probably you should have to have clarity that how you want that mojo to. If you want to build a feet on the street, then that kind of cost would be required. I'll say feet on the street could be a senior sales guy even. So from that perspective, I will put it this way that you should have to have that kind of conviction, maybe with product strategy 1 or product strategy 2, that if that doesn't play a role, then this would be a cost. But then this, if you have done the iteration of product strategy 1 and product strategy, you were knowing yourself that which product strategy is putting me more cost to it and where I see less impact happening around. So, so in a way, if I have to answer this, your question, I will put it this way, that this helps, this kind of iteration helps you that what strategy should work for you. And the more iteration you would do, the more conviction you will have it across that this PMF, I will take it up ahead. Even I will, for that, even I have to change the strategy. Like edge tech is a very good mass market if you have to look at it today from a Southeast Asia perspective. Anything which you have to look at it from a B2C or a perspective, I see Southeast Asia as a pretty good market from an edge tech perspective. So what I'm saying here is that probably we need to just figure it out, keeping those matrices in mind, what helps. Hope this answers your question.
Yes, thank you.
There is one
Pleasure.
question from Ashish. How about founder's salary? Should it be the part of model unit economics? And what's the idle mathematics behind?
Okay. So I will answer Ashish this way, that probably how long a founder should not be paid to. Now, this is a $1,000 question to it, or a $100,000 question to it, but I'll put it this way. Probably some point of time we should start putting a number to it. Now, what number it could be? It could be a 10,000, it could be a 25,000, or it could be a 50,000. I will rest it with the founders, but probably I will put it this way. Yes, once you are a revenue making company, externally funded or not, I will not put it that as of now, because somewhere down the line, founders have to put a salary to it. Now, this becomes exorbitant if you look at it from a perspective that if you put it, say, 2 lakh straight away or 1 lakh straight away. I'll talk in terms of specific numbers to it. But yes, if it's a 20-25,000, you probably I will put it this way, that if you're a revenue making venture, funded or not funded, I will not put it that too. You should start writing some numbers to it and start taking that number. Probably what number it could be, I'm leaving it to the founder, but yes, it should be a number which should be not very high from an overall cost perspective. Because then probably the dynamics, because then it shows that it's a probably you are taking cash from the company, which should not happen ideally. It should be actually a remuneration, not a cash from the company which founders takes it up. So it should be a number which is could be a 20% of overall cost, or a 15% to the cost, or okay, from the revenue perspective also, I'll say as of now, to begin with, should be a cost. Maybe some point of time when they have external directors, they have got externally funded, then probably they have a fairly good overall people with them who can help them to take a decision to, because it's a company matter. Probably I can't take a decision to it, but then it's a company matter. Once you have a independent board to look at it, who can take it and decide that you should take a maybe a revenue-based salary, which could be say 2% or 3%. But yes, to begin with, it should be cost related and should be a meaningful number, not be exorbitant. I'll put it this way. Hope Ashish, this answers your question.
Yes, sir, it does. Thank you so much.
Thank you. Yeah, Rakesh.
We have Rakesh. Yeah, Rakesh, please go ahead.
Hey, Hemant, one thing, if you could help understand, I think you'll be very close to investors in the room discussing, debating for many of the decisions you've made. I think if you could share, typically what kind of debates happen around when you're looking at the probable cases. If you get, let's say, 30-40 proposals, you might be narrow it down to some, maybe 3 or 4, which you'll be debating with investors, like which one we should go with. So in those kind of cases, around unit economics and profitability, or around these kind of numbers, where the make and break debate happens, where you finally put a finger saying, let's go with this one. If you have some things you can share, those insights will be very helpful.
No, please. Happy to answer that. So today's word globally is talking about free cash flow. So I have not seen Indian investors being vociferous about it, free cash flow. But yes, if you look at it, so I'm currently a late stage VC. We just talking about it to understand that what is happening at, so they are from California side, and I was talking to them and figuring out. So they said that they're a late stage deep tech venture. And they are VC, and they are looking forward to invest now in India as well, pre-IPO kinds. But then they were saying that today's world is moving towards the free cash flow. Now they are a later stage, so I see most of here are not from their perspective, but how I see this across is that if I have to head a family office and to look at it, which will be meaningful for all of everybody who is here from early stage to later stage, probably free cash flow is something probably we can help you in terms of understanding that how I will be getting paid back. And if mind you, in fact, most of the venture tech which I've seen, like, nobody talks about exits, nobody talks about cash flows, everybody talks about P&L. No, we should talk about cash flow more, because through cash flow only I can pay it back to my set of investors. So
is that Hemant, is that what actually in the investor rooms you guys debate? Do you look
Yes,
at the
very
cash
much.
flows and say ki
Yes, very
this
much,
company
cash flow.
kaisa hai, this company kaisa hai, like that?
Bilkul
And
bhai,
you do that?
Bilkul bhai. Bilkul bhai. So
Okay.
one is of course free cash flow and second is EBIT. Now EBIT, what happens is that over a period of time EBIT should go up. Now what number it should be is something is debatable yet. We have not found a solution, rather a number to it, that EBIT should grow by किसी का अगर मान लो 20% है, so वो 22% हो रहा है कि नहीं हो रहा है. But yes, any company which has a EBIT towards a jiska margin is going towards a incremental side of it is always a positive sign to it. That shows that commitment is there of founders to bring down the cost or developing revenue lines which is ultimately building the EBIT to it. Because what is happening today, top line is fine, but how the bottom line is built up is the most important thing in nowadays world. And I hope free cash flow is all about bottom lines. So primarily that how we are building up the bottom lines. Nothing against one of the wallet which is already listed today, but probably they are still struggling to figure it out. What could be their PMF, a paid PMF, where they make major money out of it. Either they should charge to merchant, either they should charge to customer like us. They are not clear about it. So probably unless until we have that kind of probably numbers clear to internally, because then this numbers helps you in terms of figuring it out that what margin you are working with. The margin helps you to understand that what eventually you are getting the EBIT to yourself. And in fact, 0.5%, if you make it more, probably with a larger base, you know that what numbers it leads to. So, and of course, what I've just talked about it, miscellaneous expenses of a tune of quarterly on a 1,000 crore. Now, if you look at it, if you do this kind of calculation, this kind of sheet, probably you know that where is your cost moving to. Create an actual towards the projection. And so probably you can yourself figure it out that where things are not moving as per your comfort, as per the plan.
Get that. Just one last one in Hemant also.
Please.
See, when you're looking at, because you're saying late stage, and there is a dynamics difference between somebody is very early versus somebody late. A lot of differences happen. But let's take a company which has a history as well as you have projection. So when decisions are being made for the investment, in your experience, the historical trends or historical demonstration of what they have done, whether it's unit economics, the profile, top line, bottom line, all of that, that carries a lot more weightage for investor, or what is the future that they are promising that carries more weightage?
Fantastic question, buddy. To answer this, I will put it this way: is one more factor has to be taken in is a team. That how much, which is missing in India ecosystem, is that how much vibrant ecosystem you have built of where probably you are looking forward to create an independent board for the company. Because gradually, once you are building it up, a venture, probably team holds lots of value to it. So that is first, team. Second is to answer it across, yes, previous data is fine, but then how does it leading to? So for example, if a CRM-based company stays to be a CRM-based company, then I doubt an investor would have interest to even with a higher EBITDA. Now, if that CRM is not leading towards where he is monetizing the data from the CRM perspective, I believe that is not helping me across. That was helping the founder across. So then probably I will maybe pass it across because I don't see the wisdom count coming to the data which they are looking from the CRM. So honestly speaking, on one side, yes, what pace they have been able to look at it. So if you take over the CRM, what is the pace they have it across in terms of acquiring the customer? That is one. And when we say pace, even at say, if you have say first month you have done one customer and like next month you do 2 customers, probably was that a pace? That is something we have to question ourselves. So probably in past, what is it they have been able to put a growth to? That has to be looked at it. And going forward, against with a futuristic bent of mind, what numbers they are looking forward to it. So for example, now how I see this across is something which is from my wisdom is by 3 साल में we all should be a 25 crore company. If we are not 25 crore ka company, we should stop our venture. Sorry, it is a slightly a hard point to everyone here. But let's look at it that 25 crore का company हमें 3 साल में बनना है. अगर हम 25 crore का company 3 साल में नहीं बने, we should stop our businesses. Because ultimately competition is coming up. We have to look at it that how fast we can put it this entire piece to that level of that everything should get stacked up to. And as I said it across, on a base of a 10 lakhs, 20 lakhs doing 100% or 200%, 400% doesn't make any sense to it. So the one current cohort which I'm given a very not a very aggressive one, but I just told them across that this is the number we have to target it across by anyhow. This year they're looking forward to do 1 crore. I've told them to do 5 crore, and next year they have to do 25 crore. They're into B2B business.
We hear you. Thanks, man.
Hope this answers your question. I'm just giving you this heads up of how things are happening around.
Yeah. Thanks, man. Thanks.
Yeah, pleasure, bhai.
Yeah, there's one more question from Prakhar. Is GST included in EBITDA calculation?
EBITDA calculation, no, but cash flow, yes.
And like when we talk about gross profit, right? So
right.
So we have to deduct 18% GST there.
Okay, gross profit, I hope not. Net profit, do it across because that helps you.
Okay.
Though that's an input, you get it across, but I'm just putting it across from our perspective. If they get through the chart accountant for, if you want to make it audited, then they will take care of it accordingly.
Okay, because like 18%, like our margins reduce, right? We show this like 18% is.
No, I agree, but ultimately no. So basically, this is you are doing it for internal controls, buddy. It has nothing to do with the audited one. This is just you are putting internal control, and you know that how your cash flow would be.
Got it. Yeah.
Actually, how this will help you. So this will help you to look at it. Say for example, probably you go to bank account and say, yes, it is 2 crore 63 lakhs.
Mm-hmm.
This is how probably I'm looking forward to it between all of us.
Got it.
Hope this answers you.
Yes, got it.
Yeah.
Yeah, I don't see any raised hands or queries on the chat also. So probably we can carry on.
Okay, fantastic. So now, if you look at it here, we had to be, as I told you earlier about it, that don't carry it away by profit word, because profit is something. If you look at it, this particular, I'll show you if there is a net profit, gross profit thing here. So here, if you look at it, your net profit, gross profit would be every year, it would have a new calculation to it. It would never get carried away by the previous one. It's only the cash flow which carries in your bank. So don't get carried away by profit. Always think about that how you build your cash flows to it. Because ultimately cash flow is only which is going to drive your businesses, which will help you to plan it accordingly. Finding an investor off the hand. So I was talking to one Pune based ventures. I said that how fast we can close it. I said, I don't have a magic wand to close it faster. Probably we need to first figure it out that how well prepared we are. So fine, we are making revenues to it, but then ultimately is that stacking up to building my EBIT margins? It is helping me grow my EBIT margins. So ultimately those things helps to take more. So it could be an investor who doesn't know much about that particular segment. I'm just giving insight, But once he sees this and he gets validated by the past data, he gets motivated to invest. The idea, so I was talking to in previous cohort, I was talking about it, that probably for us, what we need to do is we have to keep getting into the mode of, once we are getting into the mode of fundraise, we should look at it that how we can build a larger base of investors who can look at us. The larger the base we have, the more success which can happen to us. And how this larger base can happen. Because if I'm a guy into something to do with a B2B business, and I would be always looking at a B2B business to invest, probably. But then if you can show him across, this is how you have built the business too. Though you're into a B2C business, but this is how you have built it up. Over a period of time, this is how you're going to build the more incremental margins to it, probably. So this would help them to take a decision to invest or not to invest. And I'll tell you one thing more, probably word is too small. So you never know, probably if he is not looking to invest, probably he can refer to somebody who is looking at it, this kind of matrices to invest. So this is an enabler. This is a sure shot guarantee, no, but this is an enabler towards the right practices of how you should count yourself in for a funding perspective. Because it gives you more decisiveness in terms of how you should take it up. It gives you more in terms of that how things should stand over a period of time from a month-to-month perspective. Early stage, non-revenue stage, everybody, this matters. Every money, every single penny counts. And whomsoever you want to bring as a co-founder, whomsoever you want to bring it on the table. So I'll say stakeholders across. Probably this kind of things can help them take a decision to be part of the journey. Now, request to all of you, make this across and show it to somebody whom you're looking forward to make yourself part of the journey of your game plan. Show it across to him or her. It's a, for 100%, at least they will revisit. I don't guarantee that they will come and start exploring with you, but they will certainly look at it. So here I'm saying as a co-founder, could be for the investors as well. This is something which could be looked at it from across the stakeholders, enticing them to be look at it from a perspective of decisions, their respective decisions they want to take, either to be part of the journey or to be taking investment. Hope any questions here, what I just spoke to? Okay, lovely. So now I'll just talk about 5-10 minutes more on our very early stage perspective, how we should do a fundraise. Though this was not part of it, but that's also one of my thing which I love to speak about it. So my request to everybody who has been into early stage and looking forward to raise, probably see that if you can do a convertible, because it's too difficult to think about that what could be your valuations. So do a CCPS, do CCD. The idea here is that probably this helps the incoming investor to look at it more from a perspective of, yes, this is something he's talking in terms of milestone perspective, that maybe I'll give you a 20% discount in 3 months, I'll do a larger fundraise. So here the idea is that probably you want to, if you have to entice somebody, probably you have to show them that how things would be in your case. Probably you have not been able to show it across by delivery because you're at early stage. But yes, going forward, I'm very much convinced that by unit economics, I will achieve this number too. It could be a minuscule, but then unit economics help you across in terms of understanding that what would be the number I will be getting into. Not maybe could be 3 months, 4 months, 6 months perspective, but that would help. And that point of time, you can say then when I will do that, probably that point of time I will convert it across, because that point I'll do a larger fundraise and I'll give you a 20-25% discount. So probably you will have on one side, probably you have probably you're talking yourself in terms of milestone perspective on one side. On other side, probably what you're looking at is you will not lose higher equity to set of investors. In India, probably you will find investors who have been looking at it, they look at equity in a different angle, probably, but this is how you can straight away do a negotiation with them. Because ultimately, if the company doesn't get valued over a period of time, what will happen to them, even if they take 50% of the company? So the idea here is that probably this helps you to negotiate better to investors. Yeah, here I'm just taking a point on a investor perspective. Any questions on this? Convertibles, valuation?
Hi, Hemant, this is Shiv. I have a question.
Yeah, sure. Yeah, please. Yeah, sure,
Hello.
please. Yeah,
Yeah.
sure, please.
So this, this convertible versus an equity, is it our decision or is it the decision of the investor? Because I would think that, depending upon who we're talking to, right? I mean, if you're talking to angel investors or friends and family, we can say, okay, you know what, hey, we're doing a convertible. But if I'm talking to an early stage VC, do we really have leverage to say that, or is it dependent on the quantum of the amount being raised, or yeah?
I believe, well, I will not talk about the quantum as of now, because that's a case to cases, or maybe case specific. But I'll talk about probably how confident you are in terms of your venture. That is the most important thing, and how you value yourself. I know there could be a sense of desperation when we talk to set of investors, but primarily how I look at here is that sense of desperation is always the last resort to look at it. The first thing is that probably how value you yourself the company is. How you are confident in terms of you want to build that particular comfort level. So if you say that I will be a revenue making company in 9 to 12 months time, but today I feel that because I have a pre-revenue venture, I'll not be able to give any valuation to it. But giving a certain kind of equity would not be a something which I look at it from a long-term perspective, because I have no idea that, or maybe with this cash flow, you can say that I have looking forward to raise, say, 50 crore over a period of time. If I lose equity today, how I will do a 50 crore raise over a period of time? So, so to answer you here is primarily you can tell him that if I am putting a number to it, eventually this is going to help him. So you put a number, and then probably there's a room to negotiate. If you will get it to investor, drive it across, they will come with X, Y, Z or something, which probably you have to go back and do a homework. But get yourself prepared with cash flows. Go to them with more preparation in terms of that, yes, I value my venture, say, to this level, and I see this across from that perspective, that from an early stage perspective, I should value myself that when I do 9 months fundraise, I see a 25% discount rate. I hope everybody understands how CCPX and CCP works. What this answers it?
Yeah, and just a follow-up. So is there anything that stops me from having multiple CCD rounds, or is it looked down upon, or is it like you have, like, is there a rule of thumb or anything like that, that says that?
No. So any point here is that there is a cap you have to put it across in terms of time when you want to convert a particular round. So there is a ROC guidelines to it, probably share. And I will request Sony if they can do one session on this the ROC side of it as well, to give us a bit of nitty-gritty to understand from a corporate law perspective. So ideally, yes, we can do multiple, but then probably we should look at it. The previous one which we have got the convertible, we should look at it to convert them as well. We can't keep doing convertibles at every level. We have to keep looking at it. The convertible which we have raised earlier, they should also get converted, because there's a time to it. It's not open-ended convertibles.
Right.
Because by default also you get a valuation to it, no? Your venture.
Correct.
Yeah.
Okay. Thank you.
Vinay has his hands raised. Vinay, please go ahead.
So I have one question on this one itself. Like on convertible notes, is it when to convert? Is it event driven or timeline is also paid? Like suppose I'll say next 1 year, by end of 1 year, if I'm able to raise the fund, then on a discounted pricing, we can allocate the share. or it's a time bound also. If we are not able
It's
to
always a
suppose
time
raise
bound,
the
sir.
fund.
Sir, Vinay, it's always time bound, one. But parallelly to time bound, there is one more thing to it here is, I believe we should not get into the nitty-gritty of what is we have to look at. We have to just go by the flow of our businesses. It is, of course, it's a time bound, 9 months, 12 months, whatever it may be, but let's go by our internal cash flows as well. So my request to here is, everything doesn't go by thumb rule. Let's look at it practically how things also happens here. Because अगर आपका वेंचर अच्छा कर रहा है, अगर आपका 10 करोड़ का रेवेन्यू जो आप एक्सपेक्ट कर रहे थे 12 महीने में होगा और आपने 10 महीने में किया है, get the investor on table, start negotiating with him. Give, if you have taken a 12 months time, maybe for 25% discount, let's do a 20% discount, convert them. So the idea here is probably let's look at it from both the sides. I being on the other side of it, probably I feel that you should look at it more from a perspective of where you drive things with milestones and deliver them in a meaningful manner. Hope this answers you, Vinay.
Yeah.
Hey, Rajkumar here. We have raised our pre-seed in 2021. Now we are with that time we had only the software in mind, which was what the product we are in. Now we are entering into developing of hardware solutions and other things. So now we need a much more significant cash requirement, fund requirement for the capital investment and other things. So now the pre-seed which has been done is a compulsory convertible notes kind of thing done. Now in the second case, when you are going to raise funds, how do we treat them and how do we, because it's not a share, it's a convertible. So how do we handle that part of it and how do I get things sorted out? And what is the best approach?
No, so okay. So now this is so basically what is happening here is happens here is that you have taken that in account that probably this would be a convertible into equity over a period of time, but that has not happened yet. So what happens here is that in that scenario, my request to you is that sit with investor and see if you can convert them. The idea, because if you want to do a larger raise, probably he will get a slightly upside to it because you have to do a slightly, you have to put a bigger valuation to it. And the bigger valuation, maybe he will get a larger kind of equity, which probably you have not thought that point of time. So my request to you is that sit with investor, try to explain to him where. So this is exactly what has happened, that in a way that 10 crores, which you're looking forward to do a revenue in 12 months, you've done it in 6 months. So probably sit with that investor and tell him across, this is the scenario which has happened. And probably you can go with your number to it. That we had it in mind to give you 3% equity with that point of time conversion we had. But now with this calculation, it is coming to 6% or 10% kind of a thing. So tell him across this perspective, and I hope he will agree to it and say, okay, convert it at 3%. Because this is a genuine problem. I'll not say problem. This is actually which is helping your company is growing. So actually what is happening now in this scenario, he is going to get a larger equity, which probably you have not anticipated at that point of time.
Yeah, exactly.
So sit with him, discuss it out. I hope probably get a solution to it.
Okay. Just a follow-up.
Ideally, investors do understand the problem statement which you are talking about it. And they will be happy because ultimately their money is growing, man.
Okay.
Yeah,
okay, just to follow up on that, if I were to bring in the next stage of investors now, I might not want to do convertible. I don't want to do. I want to do equity from now on, going forward.
Yes.
So what you are saying is, if I have promised a certain percentage, we have promised a certain equity, which is a note as it stands. So convert it at a lower percentage or whatever, negotiate and get an amicable worked out between the two. Yeah, and then when I'm bringing in the new investors, that time. Does that mean that the old ones will get bought out, or how does it work?
Okay, great. Good question asked, but ideally it is like bought out again. Usually what happens, new investors coming, they come with their own set of way of they want to take it forward. So I have no idea that they want to take a strategic minority shareholding in you, or that I have no idea about it, Raj. But I'll put it this way, that primarily let's understand from the perspective perspective of investor, what is looking at it. So I'll tell you one thumb rule which is happening in current practices. None of the investors is interested that money has to be given for the secondary transaction. It should be primary. That means that money should come in the company.
Okay.
So, so most of the investors which is coming in follow-on round, they don't want it across that the money should be used for secondary purposes where you pay out to the previous investors. Unless until the new investor comes and said that I want 10%, 20%, 25%, significant mandatory shareholding, which is 26% in your company, then it's a separate issue. Then maybe it would be, you could say that you can buy it from, rather why we should pay it from the founder's pocket. You can buy this set of investors as well.
Okay. Okay.
Yeah. So in case still you want it across, probably you can connect one-to-one also, and probably we can discuss that.
Sure, sir. Sure. Thanks a lot.
Anjan, you are at mute.
Okay. What I was telling is, thanks, Hemant. I think we'll stop at this stage unless you would like to add something more. And I have a small question from all the participants. Would any one of you like to just take a minute and to say 2 things what you learned today? I think that'll be a very, very valuable input for all of us, because there are so many nuggets which came out. Most important on the valuation part, on the timing part, and how you can talk to the investors if your business model has become much better than what you had thought of before. So maybe if anyone would like to say something, you can raise your hand and then Sony can put it across. Or you can just start off. I mean, there's no issues on that one. So I'll just give half a minute for this one, half a minute to 1 minute on this.
I think the first and foremost is the fundraising does not depend on the revenue. It depends on the cash flow, which is very important.
Wonderful. Wonderful. Cash is king. Okay.
Vikalp has written on the chat box, first, the exact definition of top line and bottom line, and second, a great template for creating the cash flow document.
Take care. Good, good. Okay. Anybody else?
I think for me, the biggest takeaway is how important cash flow projections were. So I built the business model, but not the cash flow projections, thinking we're not doing sales yet, so we'll build it when we get there. But I see you need to do it beforehand. Yeah.
भैया वो गुजरात से है ना, so
of course
you have to give पहले रोकड़ा देखेंगे उसके बाद profit देखेंगे, right? Okay, thanks so much, and I think with that I'll close the session today, and maybe we've got a great weekend ahead with the World Cup final coming up. I'm sure a lot of you will be watching it, and wish you all the best, and of course the Christmas and the New Year shortly around the corner. Oh, we'll take up things after that. Thanks. Okay, have a wonderful time ahead. Wish you all the best.
Thank you very much.
Yeah.
Bye.
Thank you, guys.
Thank you so much, Hemant.
Thank you, Hemant. Thank you, everyone, for joining in. Thank you, Anjan sir. Bye.